Right, lesson number one. Sean here from Mel's YouTube book site YouTube channel. Okay, my name's Sean, and this is our start of our basic bookkeeping course for beginners. Now, I did a video earlier. Well, I did a video on the introduction to basic bookkeeping. Now, this is important if you know nothing about bookkeeping, if you've never had it at school or ever. I suggest you go and look at that video because it's got all the basic core principles and concepts for bookkeeping, and it's going to help you apply everything that we're going to learn in these lessons that follow. If you know a little bit about bookkeeping or you're quite competent in it, then you can just follow me. Okay, so let's get started, eh? Okay, so to begin with, we're going to open up a small business, Mal's Wholesale Bicycle Store, and then we're going to buy stock from some factories, and then they're gonna invoice out the supplier's invoice from all the stock we bought from them. Okay. Now, this is an example of a T account, how T accounts are in bookkeeping. For example, a general ledger income statement always on the debit side has a purchases and a credit. A purchase is an expense. On the credit side, it always has sales and income accounts. Cash books always have expenses on the debit side and income on the credit side. Petty cash has always the expenses on the debit side and income on the credit side. VAT and retained income. Very importantly, they can either be a debit or a credit, depending on how the figures flow out. So, for example, VAT can either be a credit or debit, depending on if there's more sales than purchases, it will then be on the credit side, which means that payment is due to the receiver of revenue. It means we owe money. But if more purchases are made than sales, it'll be on the debit side, which means no payment is due to him. We don't owe him any money. Okay, retained income can be a debit or a credit. If there's less income and more expenses, it'll show as a loss on the debit side. But if there's more income, it'll show as a profit on the credit side. And in these videos, just watch my mouse because my mouse follows my train of thoughts. So wherever you go, if you feel a little bit lost, just watch where my mouse is going because that's how I'm leading you around. All right, important. Don't forget it. Okay, so trial balance. Okay, now we bring forward the retained income into the trial balance, and as I said, it's either a debit or a credit, depending. The income section, sales and interest received entries always going on the credit side. Expenses on the debit side, purchases. Long-term liabilities on the credit side goes the capital account, the motor vehicle account, and the loans account. For example, these are explanations for these entries on the credit side. Like a loan to a business would be a capital account. Car finance, loans from the bank or loans. All right. Long-term assets always on the debit side. Computers, business premises, furniture, all the stuff you physically see that you own. And on the credit side will go the depreciation of those items because everything depreciates over time. Nothing keeps its value, and this is what it depreciates at, and it goes on the credit side. Current assets, bank loans, loans to staff, inventory, and customer accounts always on the debit side. Current liabilities, petty cash on the debit side, and suppliers accounts on the credit side. As I said earlier, VAT can either be a debit or a credit. All right. Okay, the general ledger. So we opened up a bicycle shop on the 1st of March 2016. We bought 50 bells at $5 each, excluding VAT. And we put them up for sale at $15 each, excluding VAT. We also bought pumps and we bought saddles as well. Now we're going to open up a general ledger book. But what we're going to do is this is the train of thought. This is the way we are leading the lessons. So these points, these things here are not in this lesson. They come in later lessons. But A and B we're going to do right now. So number A, you open up the inventory account and enter the costs of goods bought from the supplier's invoices. B, we open and enter the purchases and sales accounts from the invoices supplied. We're going to do that right now. All right. All right. So now this is an invoice. We went and bought some stock from factory A and factory B. And they invoiced us out for the stuff we bought from them, the goods we bought from them. So from factory A, we bought 50 saddles at $20 each. We bought 50 pumps at $10 each. And they totaled up the amounts we bought from them. They added in the VAT. So that's $1,725 we bought in total goods from Factory A. And we bought some stuff from Factory B, as you can see as well. And this is the invoice they supplied to us. All right. Now we're going to take that stock we bought from those factories and enter that stock into our inventory account. But very important, this is what you need to understand. An inventory account is a record keeping of the stock we bought from the supplier and the stock we sold to the customers every month. So basically, it's keeping a record of our ins and goings, our coming in of stock and our going out of stock. That's what it is. It's an accurate record of that. Okay, so we must now enter the goods bought from the suppliers and put the stocks into inventory, and that's exactly what we're going to do now. We're only going to fill out the debit side. We're going to do the credit side when we sell those stocks. When customers come and buy from us, and we sell that stock to those customers, we're going to put it here on the credit side. But for now, we're going to enter the stuff we bought from these factories. So, for example, for Factory A, we bought 50 saddles at $20 each. We bought 50 pumps at $10 each. We added them up and we got to $1,500 worth of stock that we bought from Factory A. And we bought goods, from Factory B as well. The total amount is added up. So in total, the total stock bought at the cost price was $2,250 from both those factories. Okay. Now, we have some customers. We have some customers. We just put in the stock and the customers are already knocking on our door. Wow, we're doing well. Okay, so Mr. Collins, Mr. Church, and Mr. Welsh are customers. They came and bought some stock from us. Let's start with Mr. Collins. He came and bought 10 bells from us at $15 each. So that's with the markup. We bought the stock, those bells at $5 each, and we're selling them to Mr. Collins at $15 each. We bought 20 he bought 20 pumps at $20, and he bought 15 saddles at $35. Added this all up. He added this all up, and we then put in the VAT for him. So in total, the invoice that we gave to Mr. Collins was $1,236.25 in total. That's the amount of stock he bought from us. Mr. Church came and bought some stuff from us, as you see, and so did Mr. Welsh. Okay. Now, very important. The purchaser's control account of stock bought shown as seen as a T account in the general ledger on the debit side. So we're going to open up a purchaser's control account. Now the purchaser's control account goes on the debit side in the general ledger. So this is just an example showing you where it goes in the general ledger. All this here, all these figures written out clearly and accurately, all put down here in the exact same format, is put on the debit side in the general ledger. We just can't show it because of screen limitations and whatever. It can be quite large. It can take up so you just got to remember everything that's here in the purchase control account as it's laid out there goes over there in the general ledger. All right, so we're going to debit the purchaser's control account with goods sold to the customers at cost price, excluding VAT. So Mr. Collins, he bought 10 bells at $5 each. That's $50. He bought 20 pumps at $10 each. That's $200. He bought 15 saddles at $20 each. That's $300. In total, the amount that he bought from us was $550 worth of stock. We do one for Mr. Church as well, and also for Mr. Welsh, or the stock that they bought from us. We add up the total stock that was bought from us, $1,275 worth of stock. So the month of March, the total customers' invoices at cost price, excluding VAT. Stock bought. Bells, we sold 35 bells at $5 each. Pumps, we sold 50 pumps at $10 each. Saddles, we sold 30 saddles at $20 each. We added that all up, it came to $1,275, and there you see it matches. All right, so we put this amount to the inventory on the credit side and the purchases in the trial balance on the debit side. So that's exactly what we're going to do now. We're going to put this in the inventory on the credit side. So there we go. Now remember I said to you we're going to fill out, once we sell this stock, we're going to fill out on the credit side all the stock we sold. All right, we came to that. That was blank. So there's factory A and B like earlier in the early inventory account. So we're going to enter the goods sold to the customers at cost price and put it into the inventory. So we sold 30 saddles at $20 each. We sold 50 pumps at $10 each. We sold 35 bells at $5 each. We added that all up, and it came to 1275, $1,275 worth of stock that we sold. Here we see the closing stock. Now, the closing stock is a record. It basically tells us how much stock we got left after we've sold all this. So we're just subtracting. So here we bought from Factory A 50 saddles, and we sold 30 saddles, and we left with 20 saddles left in stock. We bought 50 pumps from Factory A. We sold 50 pumps, so we left with nothing of those pumps that we bought from Factory A. We bought 50 bells from Factory B, but we sold 35 bells. So that leaves us with 15 left in stock. And we also still bought, because we're doing this per factory, we also still bought 50 pumps from Factory B, but we didn't sell any of Factory B's pumps. So we still got 50 left. All right. So the total stock bought at cost price was $2,250, and the total stock sold at cost price was $1,275. We take this amount and we subtract it from the stock bought. So there it is, 2225 minus the 1275 leaves us with $975. That's left. That's the stock we still got in the storeroom. We put that to the inventory in the trial balance on the debit side at month end. And this 975, when we close our books in March, the beginning of April, we open up a new inventory account. And in that inventory account, we bring this forward into that. The opening balance of that inventory account will be 975, and it will go on the debit side. Because remember, on the debit side is the stock we bought. That's how much we still got left in stock. Okay, I hope you understand that. Okay. Once again, remember, the inventory account is a record keeping of the stock we bought from the supplier and the stock we sold to the customers every month. Okay, just get that all in your head. All right, so we're going to put this invoice again that we invoiced out to Mr. Collins for the stuff he bought. Remember earlier I had this invoice up the top. We're just going to put it out again so that you just as a reminder, because we are now going to do, watch my mouse, we're going to do the sales account, control account. All right, including the profit price, excluding VAT. Okay, so it includes the profit price, excluding VAT. And once again, I'm giving you this analogy from the general ledger because, like the purchases control account, the sales control account also goes into the general ledger, but on the credit side. So just like with the purchases control account, everything the way it's done here, you see it's all laid out, will go in the exact same format on the credit side in the general ledger. Okay, so as it says, you credit the sales control account, including the profit and excluding VAT. Okay, so Collins, invoice, he bought 10 bells at $15 each, and that was $150. He bought 20 pumps at $20 each, that's $400. He bought 15 saddles at $35 each, that's $525. The total amount he bought from us, including the profit, excluding the VAT, was $1,075 in total. And Mr. Church as well also bought the stuff, and we added up here and same the Mr. Walsh, as you can see on the screen. So the month of March, the total customers' invoices, including the profit, once again, and excluding the VAT, is $2,575. So total $2,575 you put to the sales account in the trial balance on the credit side. There we done. Lesson number 1. Hey, we done. Okay, cool. So look, I've tried to explain this as best I can. All right. If you have any questions or you want to ask some questions or you have some comments, please let me know. I want to make sure that you understand this. It's a very important lesson. All right, let's get to the top. Okay. There we go. Lesson 1. So please like this video. Please share it with everybody you know. And please subscribe to our channel. And once again, if you have any questions, queries, you have any comments, please ask us. I'm always available to try and help as much as I can. All right. See you at lesson number 2. Good day on you.